This segment will look at the net present value as a capital budgeting tool. The net present value tool considers the time value of future cash flows associated with an investment option. The time value of money is a concept that recognizes that a dollar received in the future is not worth the same as a dollar that could be or would be received today. In order to apply this net present value tool, the first step is to calculate the present value of all future cash flows from a potential investment that is being considered using the company's required rate of return, sometimes called the hurdle rate. The second step is to subtract the initial amount invested from the present value of all those future cash flows. So let's apply it. ABC is considering the purchase of equipment that has an initial cost of $16,000, an 8-year useful life with no salvage value. This investment promises an annual cash flow of $4,100 per year over the life of that asset. ABC's required rate of return is 12% annual return on any investments that it takes on. So the first step is to present value all of those future cash flows. Recall that the future cash flows are $4,100 per year over 8 years. If we were to take a present value table, which is available in all accounting textbooks, you can also easily find this table on the internet as well. But what we're seeing here along the top for each of the columns, we are seeing an assumed rate of return. And over here along the left side of this table for the rows, we're seeing the number of periods until that amount will be received, or the amount that cash flow is expected. So in order to apply the present value to each of the year's cash flows, we first need to take the interest rate or the investment return. 12% return is a hurdle rate for this company. So we're going to go over here to the 12% column. Once we have the 12% column, we are then going to find the period row of when that amount will be received. Year one's cash flows of $4,100 will be received in year one. So we need to find the present value factor for an amount to be received in 1 year at 12%. So going to our table, we go to the 12% column to the period one row. We see the present value factor 0.89286. We are going to multiply the cash flow times that present value factor to calculate how much the $4,100 that will be received in year one is worth today. We then do the same thing for year two's cash flows related to this investment. $4,100 to be received in year two at a return of 12% will be received in the second period. Present value factor 0.79719. We multiply that present value factor by the cash flow in year two to calculate the present value of the $4,100 that will be received in year two, what it is worth today. We do the same thing for year three cash flows. $4,100 to be received in year three at a 12% return, 3 periods until that cash flow is received. Present factor 0.71178. Present value factor times the cash flow to be received that year calculates how much that future cash flow is worth today. Finally, we would do that for each year's cash flows, multiplying that year's cash flows by the present value factors appropriate for that year's period. If I were to multiply all of those present value factors by the year's cash flows and add them up, the total is the present value of all those future cash flows. Thus, $32,800 is expected to be received over the life of this investment. Those future cash flows today are worth $20,367. I'm going to take the amount to be invested, compare it to the future cash flows. Future cash flows minus the amount investment, net present value of the investment, $4,367. A positive net present value indicates that the proposed project earns more than the 12% on the investment, and it would be considered a good investment option. In other words, the future cash flows, present value, return is greater than the company's required rate of return. Ultimately, the decision rule when applying the net present value is if a project has zero or positive net present value, management should accept it as a good investment option. However, if the end net present value were negative, management should reject because it indicates that the investment does not provide a return greater than the required rate of return.